student, daily you are going to college. You are learning so many new things. How to know whether you are progressing or not? Every year, exams are conducted to you. So based on your marks, we can know whether you are improving or not. Similarly, in a businessman wants to know whether he is doing well or not. How to know whether he is improving or not? For a student, based on the marks, we can judge your performance. In case of business, based on the profit, we can know whether a businessman is efficiently doing the business or not. What is meant by profit? Profit is the difference between income and expenditure. For example, to conduct business, one businessman spent 10 lakh rupees. And by spending this 10 lakh rupees, assume that he earned an income of 15 lakh rupees. Then how much profit he earned in his business? 5 lakh rupees. If expenses are more than income, then the result is called loss. Truly speaking, the exact profit we can know only at the time of liquidation of the business. Liquidation means what? Closing of the business. For example, on 1st January 2001 year, a businessman started business with 10 lakh rupees capital, and he closed his business on 31st December 2020, and at that time he is left over with 25 lakh rupees capital. Then how much is the profit to him? In his business he earned a profit of 15 lakh rupees. But a businessman is not interested to wait for such a long period to know the profit. Even though you ascertain the profit at the time of liquidation, what is the use of that? Therefore, profit or loss and financial position are ascertained at particular intervals. So in accounts, we follow one concept, that is going concern concept. What that concept says? When accountant does accounts of any firm, he should assume that this firm will continue for a long period. When you are going to run your business for a long period, then at a particular intervals only we have to calculate the financial position and financial performance. No? By doing accounts, we follow one concept, that is accounting period concept. What that concept says? Accounts are to be prepared for once in year. So that year is called accounting year. That year may be a calendar year or financial year. Calendar year starts with the 1st January and ends with the 31st December. Financial year starts with 1st April and ends with 31st March. So you may get one doubt. Why exactly once in a year we have to prepare accounts? Why not once in 3 months, once in 6 months, once in 2 years? The reason is, for example, our product is a seasonal product. Seasonal product means what? We are selling umbrellas or sweaters, fridge, air coolers. So during some months, boom period will be there, and in some months, dull season will be there. So if you prepare accounts for once in 3 months, you will not get a complete idea about your business performance. So once in a year, if you prepare the accounts, then you will get an overall picture of your business. 1 year accounts contain all these reports. In business, if any financial transaction takes place, then small firms record them in the journal book by writing journal entries, and large firms record them in subsidiary books. This is the first step in accounts. Then all this recorded information is posted in respective accounts in ledger book. In ledger book we prepare 3 accounts: personal, real and nominal. Then all these ledger account balances are taken to trial balance. Then after preparing trial balance, we prepare final accounts. Final accounts are also known as financial statements. Trading concern final accounts contain trading account, profit and loss account and balance sheet. Similarly, Final accounts of a manufacturing concern contains manufacturing account, trading account, P&L account and balance sheet. Now what is meant by a trading concern? Concern means what? Firm, organization. If any organization is engaged in buying the final product from wholesale market and by adding some profit, selling that product to the customer, then that firm comes under trading concern. And manufacturing concern means what? If any firm purchases raw material from wholesale market and by using machines and labor in factory, if they convert raw material into finished product and by adding some profit, if they sell that product to customers, then that firm is known as manufacturing concern. First three steps come under bookkeeping. First two, trading account and profit and loss account of a trading concern, and first three, manufacturing account, trading account, profit and loss account of a manufacturing concern. They come under income statements. And balance sheet of a trading concern and manufacturing concern is known as position statement. Now, from here to here, all these reports are combined known as accounting cycle. Why cycle word we used? Because every year we prepare all these reports one by one. At present, we concentrate on the final accounts of a trading concern. Why these reports are known as final accounts? Because to prepare these reports, we depend on trial balance. In trial balance, the amounts which we record, all those amounts from where we take? From ledger. In ledger, we prepare personal accounts, real accounts, nominal accounts throughout the year. And at the end of the year, we close all these accounts and that closing balance carried on figures we carry forward to trial balance. And from trial balance only we prepare final accounts now. Means what? While preparing final accounts, all the ledger accounts are closed. And with the final figures of ledger account balances, we are preparing final accounts. So these accounts are known as final accounts for that reason. And second reason is, when we prepare these final accounts at the end of the year. For example, one firm is following calendar year as their accounting year. Then they are preparing accounts from 1st January 2018 to 31st December 2018 period. Then what is the last date of this year? 31st December 2018. On that day we prepare final accounts. Therefore these accounts are known as final accounts. And third reason is, by preparing these final accounts, owner will come to know the financial position of the business and the financial performance of the business. Financial performance means what? Whether he got a profit or loss in that one particular year. He will come to know. Financial position means what? The information regarding assets and liabilities. In that one particular year, whatever transactions we did, the end result of the transactions are revealed by preparing these reports. Therefore, these reports are known as final accounts. Based on the incorporation, nothing but registration, firms are divided broadly in three categories. Sole proprietorship concern, nothing but sole trading concern, partnership and joint stock company. Preparation of final accounts is must for all these three types of organizations. While preparing final accounts for these firms, we have to follow generally accepted accounting principles. What are they? Accounting concepts, accounting conventions. Similarly, accounting standards we have to follow. If it is a partnership organization, Indian Partnership Act 1932 rules we have to follow. If it is a joint stock company, then Companies Act 1956 rules we have to follow. Now in present video, I am going to concentrate on the final accounts of sole proprietorship concern. Sole proprietorship means what? If any organization is established and managed by a single person then that organization is known as sole proprietorship concern. This is the final accounts of one trading concern. Trading concern final accounts contain three things now: trading account, profit and loss account, and balance sheet. Once you observe this first account, this account is divided into two parts. First part is known as trading account and second part is called profit and loss account. Like this, in one account, we can prepare trading account and profit and loss account one by one. Or for trading account, you can maintain one account, and to prepare P&L account, you can maintain another separate account. Both methods are correct. For balance sheet, you have to maintain a separate table. Before learning the final accounts of trading concern, you should know one important point, that is classification of financial business transactions. Financial business transaction means what? If any transaction is related with our business and the monetary value of the transaction is expressible, then it is called a financial business transaction. The transaction is divided into three categories: capital transactions, revenue transactions, deferred revenue transactions. All these three type of transactions will be given in the trial balance. Now carefully, from trial balance, that particular transaction in respective report, proper side we have to record. So to record, you should know the classification of these transactions. Capital transactions are divided into two types: capital expenses, also known as capital payments, and capital incomes, also known as capital receipts. In trial balance, if any capital expenditure is given, then that amount should be taken in balance sheet on asset side. Similarly, in trial balance, if any capital income is given, then it should be shown on the liability side of balance sheet. Come to revenue transactions. Revenue transactions are divided into two types: revenue expenses, also known as revenue payments, and revenue incomes or revenue receipts. Now, revenue expenses are again divided into direct revenue expenses, indirect revenue expenses. Direct revenue expenses are again of two types: normal direct revenue expenses, abnormal direct revenue expenses. Normal direct revenue expenditure we should debit to trading account. Normal direct revenue expenditure comes here. Similarly, abnormal direct revenue expenditure goes in profit and loss account debit side. Abnormal direct revenue expenditure we should debit to P&L account. And indirect revenue expenditure always we have to record in profit and loss account debit side. Indirect revenue expenditure comes here. Okay, then come to revenue incomes. Direct revenue income goes in trading account credit side, direct revenue income, and indirect revenue income appears on credit side of profit and loss account. Then come to deferred revenue items. Deferred revenue items are of two types: deferred revenue expenses, also known as deferred revenue payments, and deferred revenue incomes, also known as deferred revenue receipts. Now, in case of deferred revenue expenses, the amount which we have cancelled in current year, nothing but the amount which is written off in current year is to be debited to P&L account. In case of deferred revenue expenditure, the written off amount we have to show in P&L account debit side, and the amount which we are not yet written off, that amount appears in balance sheet asset side. Deferred revenue expenditure not written off amount we have to show on asset side of balance sheet. Deferred revenue income, the written off portion in current year, that is to be credited to profit and loss account. Deferred revenue income, the written off portion, and the amount which we are not yet written off, that amount appears in balance sheet liability side. So deferred revenue income, the amount which is not written off. Now let us learn about each and every item in detail. Now the first transaction is capital expenditure. Capital expenditure, where it appears in final accounts? In balance sheet asset side. What are the characteristics of capital expenditure? Capital expenditure is a non-recurring expenditure. Means rarely firm spends this expenditure. And second point is capital expenditure gives long-term benefit to us. Means expenditure we incur in 1 year, but the benefit out of that expenditure will be for more than 1 year period. And third point is capital expenditure increases the present earnings capacity of the business. Now let us see what are those capital expenses. First one is purchase of a fixed asset. A firm spent 10 lakh rupees to purchase one machine. By using that machine, firm is going to manufacture goods. Means to that particular firm, machinery comes under a fixed asset now. And to purchase that fixed asset, firm spent 10 lakh rupees. This 10 lakh rupee expenditure comes under capital expenditure. So in balance sheet, asset side, machinery 10 lakh rupees. Like that we have to show. If there is any depreciation, then we have to deduct that depreciation in the balance sheet. So what are the other examples? Purchase of furniture, purchase of land, purchase of building, purchase of vehicles. All these things come under capital expenses. Then second one is improvement of fixed asset. If any amount is spent to improve the efficiency of one fixed asset, then that expenditure comes under capital expenditure. For example, from past 10 years we are using one machine. So one particular part is totally damaged. We replace the damaged part with a new one. So immediately machinery working capacity is increased. Then that replacement expenditure comes under capital expenditure. And third one is extension of fixed asset. For example, take one cinema theatre. Say in that theatre there are 1000 seats. So owner spends some expenditure to increase the seating capacity of that theatre. Now the seats are 1500. Due to the introduction of 500 extra chairs, the earnings of that cinema theatre will increase now. So this is called extension of fixed asset. Similarly, in one college, there are 2 floors. So college constructed another floor. Then college present earnings will increase because seating capacity is increased. Then the construction of third floor expenditure, it comes under capital expenditure. Then next one, expenditure spent to acquire the asset. To acquire the asset means don't think that to purchase the asset. That point is already covered here. Now here the meaning is we want to buy one land, for that we spend registration charges. So without paying registration charges, we cannot acquire that land. So that expenditure comes under capital expenditure. Similarly, we paid some fees to lawyer to acquire one particular asset. Then that advocate fees come under capital expenditure. Then next one, acquisition of right. Assume that we are running one pharmaceutical company and one scientist innovated a medicine. So we want to use that formula. For that, we have to purchase patent rights from him. The amount which we paid to obtain that patent right comes under capital expenditure. Similarly, we are publishing books. One author wrote one book. We want to publish that book. Then from author we have to buy copyrights. That type of expenditure is called acquisition of right. Then next one, expenditure for putting the asset into working condition. For example, there is one old asset. So to bring that asset in usage, we spend some repair expenditure. Only one time we spend this repair expenditure. So with that expenditure only, that asset can be put into use. Then that repair expenditure comes under capital expenditure. Otherwise, we purchase one new asset in other state. From that state to our place, to bring that asset and to fix in our factory, we paid some transportation expenditure, some wages, nothing but installation charges we incurred. Next one is expenditure spent to reduce the working capital. For example, we are using one machine to manufacture goods and that machine contains petrol driven engine. We replaced it with diesel driven engine. Because of this, our fuel expenditure will reduce, no? So that expenditure comes under capital expenditure. Otherwise, we have old wiring system. Because of that, more electricity bill we are paying. So what we did, we replaced that old electric equipment with a new one. Because of this expenditure, electricity bill will get reduced. So this replacement expenditure comes under capital expenditure. And the last one is purchase of investments. With our savings money, if we buy shares of another company or debentures or any government bonds, then the meaning is we are investing our money in another business. Again and again we are not going to invest like that. It is a rare expenditure, so it comes under capital expenditure. Next transaction is capital incomes. Capital income means what? If any amount is erased not from regular course of business, then it is called capital income. Capital incomes are non-recurring in nature, means rarely they come. Where you have to show them? In balance sheet, liability side they appear. And these are the examples for capital incomes. First one is amount received from owner as capital. To start business, owner brought some capital into the business. Then daily brings that? No, it is a non-recurring income. Therefore, it comes under capital income. Then next one, loan taken from bank or from any other financial institutions like IDBI, IFCI, UTI, etc. Do we take this loan regularly? No, rarely we take it. Therefore, non-recurring in nature, it is a capital income. The next one, amount received by issue of shares or debentures. Company need capital. So to procure the capital, company sold shares or debentures to public. This is a rare income, so it comes under capital income. The next one is receipts from sale of fixed assets or investments. So one fixed asset we are using, same machinery, it is damaged, we replaced it with a new one. Then old machinery, do we throw in dustbin? No, we sell that on scrap basis. Suppose some amount realized, that amount comes under capital incomes. The accounting treatment of capital income is some capital incomes we show on liability side of balance sheet and some capital incomes on asset side of balance sheet from concerned asset we deduct. For example, we sold asset. From concerned machinery, we deduct this machinery sale proceeds. Similarly, we sold investments. We purchased other company shares or debentures or government bonds. We sold them now. Then from existing shares, we can deduct this in the balance sheet on asset side. Now come to next transaction, revenue expenditure. To explain this point, I want more space. Therefore, in another chart, I am going to explain about this topic. Revenue expenditure. What are the characteristics of revenue expenditure? First point is, the benefit out of this expenditure is restricted to 1 year only. For example, we are running a firm and we paid salary to one employee. When you pay salary to an employee, the benefit from that expenditure is only for 1 month now. Next month, if you want to take the work from him, again you have to pay salary to him. Then second feature of revenue expenditure is, it is recurring in nature. So again and again we have to pay. This salary every month we have to pay. Then third point is, revenue expenditure is incurred to maintain the same earning capacity of the business. With this expenditure, our present earnings will not increase, but our present earnings will get maintained. For example, ordinary repair expenditure to machines. If this expenditure is incurred, then machine capacity is not going to be increased. It is to be maintained. So same earnings we can maintain for a long period. But if you don't spend that repair expenditure, then slowly that machine will become damaged and your present earnings will decrease. Revenue expenditure is divided into two types: direct revenue expenditure, indirect revenue expenditure. Direct revenue expenditure is again of two types: normal direct revenue expenditure, abnormal direct revenue expenditure. Now, while preparing final accounts, normal direct revenue expenditure we should show in trading account debit side. Similarly, abnormal direct revenue expenditure is to be debited to profit and loss account. And indirect revenue expenditure always we have to debit to profit and loss account. Now you should know the meanings of all these words. What is meant by direct revenue expenditure? In case of trading concern, they buy the finished product from supplier. By adding some profit, they sell it to customers now. So the expenditure which they incurred while buying the goods come under direct expenditure. And after purchasing the goods, the expenses which they spend, they come under indirect expenditure. If it is a manufacturing concern, then what is meant by direct expenditure? The expenditure which is incurred to manufacture goods is known as direct expenditure, and the expenses after manufacturing the good come under indirect expenditure. So eventually we can tell that direct expenditure means the expenditure which is spent to bring the product in saleable condition. And after bringing that product to saleable condition, if any expenditure is paid, for example selling expenditure, distribution expenditure, financial expenditure, maintenance expenditure, that expenditure comes under indirect expenditure. Okay? With one example, I will explain the difference between direct expenditure and indirect expenditure. One firm purchased raw material from suppliers. They brought them to factory. In factory, by using labor, machines, they manufactured goods. Then these finished goods, they are taking to their godown. And from them, whenever they need, then to showroom they are delivering these goods. Now this factory, godown and showroom, these three are under the control of office. Assume in this manner they are running their business. Suppose in factory, say 100 workers are working. To workers what we pay? Wage. We paid wages. Why? Because workers manufacture goods. Okay. For that purpose we paid wages. Now these wages come under direct expenditure now, because while manufacturing the goods we incurred this expenditure. And in office, to one accountant we paid salary. Is there any relationship between manufacturing process and this salary expenditure? No. Therefore, salary expenditure comes under indirect expenditure. Direct expenditure is considered while calculating the cost of goods sold. In other words, direct expenditure is considered while fixing the sale price. The wages which are paid to workers who are working in factory are known as productive wages or direct wages or manufacturing wages. Because what they do, they engage in manufacturing the goods now. So these wages come under direct expenditure and it is to be debited to trading account. Assume that workers are working in godown or showroom or office. For example, in office one watchman is there, or in godown one cleaner is there. To them we paid wages. This wage expenditure is related with godown, showrooms and office, no? So they are not related with the manufacturing process. Therefore this type of wages you have to debit to P&L account. Means they come under indirect expenditure. See, wages of workers in godown or showroom or office. The wages which are paid to workers who work in godown, showroom or office are known as indirect wages or unproductive wages. Sometimes he gives only wages word. So there is no proper information that wage is paid to a worker who is working in factory or to these people. In the absence of proper information, you have to use your common sense. Where number of workers will be more in factory. Therefore, in the absence of proper information, assume that wages are paid to workers who are working in factory. Means this wage is productive wage. Treat it as direct revenue expenditure and debit to trading account. Sometimes he may give like this: wages and salaries. If only wages are given, we take in debit side of trading account. If only salary is given, we debit to P&L account. But here two are combinedly given. Then what is the meaning of that? Comparing to salary, productive wage amount is more. Productive wages where we show, trading account debit side no. Therefore wages and salaries also you have to show in trading account debit side only. Means treat it as direct revenue expenditure. Suppose he has given like this: salary and wages amount. What is the meaning of that? In that particular amount, salary amount is more than the wages amount, and that wage is one unproductive wage or indirect wage. So give importance to first word salary. If only salary is given, we have to debit to P&L account now. Then salary and wage also we should debit to P&L account only. Remember one more point. Suppose we purchased one fixed asset. To bring that fixed asset, to install that fixed asset in our factory, we engaged one worker and to that worker we paid wage. It doesn't come under revenue expenditure because only one time we incur that. It is to be added to that particular fixed asset value. Means if that wages are to be capitalized and it should be shown as an asset in balance sheet. Similarly, he has given in the trial balance that salary to factory manager some amount. Now by seeing salary, don't debit it to P&L account, because to whom we are paying that salary? To a manager who is working for factory. He may sit in office, it doesn't matter, but his functions are related with factory, So factory related expenditure, this is, therefore it is to be treated as direct expenditure, so debit to trading account. And if he gives that salary of office employee, salary of godown employee, salary of showroom employee, then no doubt it is indirect expenditure debited to P&L account, because this salary is not related with the manufacturing process. And sometimes he may give only salary word in the trial balance. So to whom this salary is paid, there is no proper information. In that case, you have to use some common sense. Where the number of employees will be more, in factory or in this 3? Here only. Therefore, the meaning of this salary is, it is paid to an employee who is working in either godown, showroom or office. Treat it as indirect expenditure and debit it to P&L account. Next one is rent of factory building. Firm has taken this factory building on rental basis, and to the owner of this building we paid rent. So factory related expenditure is a direct expenditure now, it is to be debited to trading account. And if he gives rent of godown, rent of showroom, rent of office, then it is to be treated as indirect expenditure, so debit to P&L account. Suppose trial balance contains only this word, rent. No proper information is given. Then once you observe where the number of buildings are more, only in one building we are doing manufacturing work, that is factory. So sales, distribution work and administration work, we are doing all these activities in godown, showroom and office. As 3 buildings are there here, the rent expenditure of these 3 buildings will be more than the rent expenditure of factory building. Therefore, in the absence of proper information, assume it as indirect expenditure. This rent is related with these 3 buildings. Therefore, debit it to P&L account. Next one is carriage. Carriage is also known as freight or cartage. What is meant by carriage? From one place to another place to transport the goods. If we spend any amount, then that expenditure is called carriage expenditure or freight expenditure or cartage expenditure. Now we may deliver the goods on roadway or by airway or waterway, railway. It doesn't matter. Then suppose he has given like this: carriage on purchases or freight on purchases or cartage on purchases. In trial balance he has given like this. What is the meaning of this? Firm purchased goods from one supplier's shop and from his place to our factory to bring the goods. It may be a finished product or it may be a raw material. To bring that, we incur some transportation expenditure. Then after bringing them to our factory, we start manufacturing process. Therefore, this carriage on purchases expenditure comes under direct expenditure. Instead of carriage on purchases, he may give carriage inward or freight inward or carriage inward. Inward means what? Goods are coming into our factory. When goods come like that, when we buy the goods, then only no. Therefore, carriage inward means nothing but carriage on purchases only. And assume in trial balance he has given like this: carriage on sales or freight on sales or cartage on sales. What is the meaning of this? From our showroom to customer's place, we are transporting the goods. We are giving transport facility to customer. Some pizza houses or restaurants or online websites, Amazon, Flipkart, etc. they give free home delivery facility to customer now. In that case, who is incurring this carriage expenditure? Firm. And these are the expenses incurred by the firm after manufacturing the goods. So this carriage is not at all related with our manufacturing process. Therefore, carriage on sale or carriage outward will be considered as indirect expenditure. It is to be debited to P&L account. Carriage outward means what? Goods are going from us. When they go like that, when we sell these goods to customer, then only know. Therefore, carriage outward meaning is carriage on sales. Sometimes he may give only these words. For example, carriage word is given in the trial balance, or he has given only freight word, cartage word. Then what is our assumption? If you practically observe, the distance between supplier's place to our factory will be more when we compare with the distance between factory and go down and showroom, or showroom to office. Clear? And for this short distance, we use our vehicle. When we use our vehicle, carriage expenditure will be less, because we are not taking that vehicle on rental basis from anybody. Only diesel charges we have to incur there. But as the distance is more here, we don't take risk by using our vehicle. If it is damaged in road accident, then we have to incur a big loss now. So what we do generally, we hire outside vehicle. So to them we have to pay some rental charges along with the diesel expenses. So comparing to this carriage expenditure amount will be more. There is another reason also. 99% which carriage expenditure firm spend? Carriage on purchases only. Rarely firm gives free home delivery facility to customer. So carriage on sale expenditure is a rare expenditure, and carriage on purchases expenditure is regular expenditure. So whenever carriage word is given, our assumption is it is the carriage which we spend on purchases. Means it is carriage inwards, direct expenditure. So take it in trading account debit side. Next item is power. In trial balance, assume he has given power expenditure and electricity expenditure. So you may be in confusion. Both are giving the same meaning. Both are expenses. In these two cases, firm is paying electricity bill to government. Then which one is direct expenditure, which one is indirect expenditure? How to decide? If firm needs a high voltage of electricity, for example 3-phase electricity, in that case power word will be used. And if we need low voltage of electricity, then we use electricity word. Where we need a high voltage of electricity? To run the machine in factory, we need high voltage of electricity. Therefore, whenever power word is given, then you have to understand that to run the machine, we use this electricity. So it is related with manufacturing process. So power expenditure is direct expenditure. And comparing to the electricity used in factory, the electricity which we use in go down, showroom or office will be less. Whenever electricity charges word is given in the trial balance, then the meaning is that electricity bill is related with these three buildings. So treat it as indirect expenditure and debit to P&L account. Now the next expenditure is heating and lighting. Suppose in trial balance, heating and lighting word is given. Then it is direct expenditure or indirect expenditure. Here first word you have to observe. Heating is given. Where we spend more money on heating the things? You know, in factory machines will be there, and to manufacture the goods we have to heat the machine or we have to heat the raw material. In office, in showroom, who will be there? Persons. You need not to heat them. So whenever heating expenditure is given, then the meaning is this expenditure is related with the manufacturing process. And after heating, lighting expenditure is there. Means what? Comparing to lighting expenditure, heating expenditure is more. Therefore, treat it as direct expenditure and debit it to trading account. Instead of heating and lighting, if lighting and heating word is given in trial balance, then what is the meaning of that? Comparing to heating expenditure, lighting expenditure is more. And where we use more lights? In showroom, in office, because so many customers visit our showrooms. To attract them, we use more lighting. We spend more money on this purpose. If lighting and heating is given, then treat it as indirect expenditure because this expenditure is related with the showroom or office and debit it to P&L account. Next one is trade expenses. In trial balance, only trade expenditure word is given. Trade expenses means what? Nothing but selling and buying related expenditure. Nothing but administration related expenditure. So trade expenditure is also known as general expenses or office expenses or sundry expenses or miscellaneous expenses. So when only trade expenditure is given in the trial balance, then take it as indirect expenditure and debit it to P&L account. But along with the trade expenditure, if trial balance contains general expenses or office expenses or sundry expenses also, then don't write trade expenses in P&L account. In that case, trade expenditure is to be treated as direct expenditure, debited to trading account, and the general expenses we should debit to P&L account. Next item is packing expenses. To decide whether packing is a direct expenditure or indirect expenditure, you have to observe that packing is coming under which category. Packing is of three types. Primary packing. Primary packing means what? Without that packing, you cannot imagine the existence of a product. For example, take toothpaste. Without packing, can you distribute the paste to other place? Impossible. Suppose ink bottle. Without that bottle, can you distribute the ink to other place? Impossible. Means what? While manufacturing that product, compulsory we have to pack it. So that packing comes under primary packing and it is related with the manufacturing process. So primary packing expenditure is a direct expenditure debited to trading account. And transport related packing. For example, firm is transporting TVs from one place to another place. So to protect the TV, they put the TV in a box and they transport it. So this packing expenditure comes under distribution expenditure. And distribution expenditure is an indirect expenditure. Therefore, transport related packing charges we have to debit to P&L account. And the fancy packing means what? In showroom, when we keep the goods to attract the customers, sometimes we may spend money on fancy packing of that good. So this expenditure comes under sales expenditure. Therefore, it is to be treated as indirect expenditure. So debit to P&L account. Next one is import duty or custom duty. If it is given in the trial balance, then where to take it? So firm is importing raw material or finished goods from another country. When we import goods from other country, to custom officers we have to pay tax. That tax is known as custom duty or import duty. Duty means tax. So after paying the tax, we bring the goods and we manufacture the goods. Therefore, this expenditure is manufacturing related expenditure, direct expenditure. So debit it to trading account. Next one is octroi. From one city to another city, when you are transporting the goods to municipal corporation, you have to pay local taxes. That tax is known as octroi. This is also to be treated as direct expenditure, debit to trading account. The next one, fuel, gas, water, coal, oil. All these are used in manufacturing process. So they are manufacturing related expenditure, direct expenditure, so debit to trading account. The next one, dock dues and clearing charges. When we are importing goods, then to port authorities, we have to pay some charges. Those expenses are known as dock dues and clearing charges. So after paying these expenses, we take the delivery of goods and we manufacture. So these two are also manufacturing related expenses. Therefore, direct expenditure, debit to trading account. Next, if any factory expenses are given, like factory rent, factory insurance, factory rates. Rates means what? Taxes. Factory lighting. Factory lighting means what? To use bulbs, fans in factory building, we spend some electricity charges to government. Then factory building maintenance expenses. All these are known as factory expenses. So factory related expenses are manufacturing related expenses, direct expenses. So we have to debit it to trading account. In the place of factory, if office word is given or godown word is given, showroom word is given, for example, office rent, showroom rent, then it is to be treated as indirect expenditure. So debit it to profit and loss account. And assume factory word and office word both are not given. He has given like this, only rent, insurance, rates. In that case, where the number of buildings is more here, so in the absence of any information, you have to assume that these expenses are spent on godown, showroom and office. So treat them as indirect expenditure and debit it to trading account. Next, excise duty. If it is given in the trial balance, whether it is direct expenditure or indirect expenditure, how to decide? First of all, what is meant by excise duty? When government levies tax on a businessman, then the tax is called excise duty. Sometimes government levies this tax based on the production. In that case, that duty is to be treated as direct expenditure, so debit it to trading account. If excise duty is levied based on sales made by the firm, then that excise duty is to be treated as indirect expenditure, debit it to P&L account. Similarly, royalty. Royalty means what? When firm hires somebody's fixed asset, then for using this asset, every year firm has to pay royalty to that owner. So that royalty will be paid based on the production or based on the sales. If royalty is paid based on the production, then treat that royalty as a direct expenditure. If it is paid based on the sales, then treat it as indirect expenditure and debit it to profit and loss account. Normal direct revenue expenditure is completed. Now next one is what? Abnormal direct revenue expenditure. Normal expenditure means what? In manufacturing process, we spend that amount and we know that we have to spend it. So it is an expected expenditure. And abnormal expenditure means what? No businessman wants to spend this money, but unfortunately sometimes he has to incur this expenditure. For example, loss of goods due to fire, accident or theft. Goods are in factory, due to fire accident or due to theft or due to any other reason, we lost those goods. Nobody wants that loss, but it happened. So this loss, even though it is related with a factory, we should not treat it as direct expenditure. We have to treat it as indirect expenditure and we should debit it to profit and loss account. Take another example. Payment of wages to factory workers during strike. Workers are working in factory. We paid wage to them. When they manufacture goods and we pay wage, it is a productive wage and we show it in trading account debit side. But when we paid that wage during strike period, means they are not manufacturing goods, but we have to pay the wages to them. Anybody wants to pay like that? No. So it is an abnormal loss to us which is related with our factory. It is also to be treated as indirect expenditure. So debited to P&L account, not to trading account. Now come to indirect revenue expenditure. Indirect revenue expenses come in P&L account debit side. And so many expenses come under this category. Indirect expenses can be divided under 7 headings. Clearly, I will give the list of indirect expenses. First one is administrative or management expenses. They are incurred in day-to-day activities of the business. Examples are salaries of godown employees or showroom employees or office employees. Rent of godown building, showroom building or office building. Lighting expenditure which is related with these 3 buildings. Insurance which we have taken on the godown or showroom or office buildings. Similarly, electricity charges which we paid for these 3 buildings. Printing and stationery. Printing means what you know. And stationery expenditure. When you run any office, then we have to spend some amount on stationery expenditure. So it comes under administration expenditure. Then postage and telegram. Postage means what? Buying envelope covers or postal stamps, etc. Telegram means what you know. Then telephone charges, legal expenses, lawyer fee, etc. Then audit fees means what? We prepared accounts and our accounts are to be certified by one chartered accountant. So we engaged one outside chartered accountant and to him we paid some charges. That charge is known as audit fees. Then staff expenses, staff recreation expenditure, otherwise staff refreshment expenditure, etc. Then general expenses or sundry expenses or trade expenses or office expenses. They come under administrative or management expenses. Now the next one is, second one is selling expenses. Under this heading, we have salesman salaries and commission and brokerage to sales agents, advertising, bad debts. Bad debts means what? We sold goods to customers on credit. Now he becomes a debtor and he failed to pay that amount. So it is a loss and it comes under bad debts. Then traveling expenses, free samples and royalty if we pay that royalty based on sales. Cost of printing, catalogs. Catalog means what? Brochure and price list. Then third one is distribution expenses. These are the expenses related with distribution of goods. What are they? Packing expenses, carriage on sales. Carriage on sale is also known as carriage outwards or freight on sale, freight outward, cartage on sale or cartage outward. Then export duty, import duty where we wrote trading account debit side because it is direct expenditure. Export duty when we export after manufacturing only now. So this is related with distribution expenditure. Indirect expenditure. Then maintenance of vehicles for distribution of goods and their running expenses. Next, insurance of finished goods in stock and goods in transit. When goods are transported, if anything happens to goods, to safeguard the goods from that type of risk, we take insurance policy and we pay premium. That premium comes under distribution expenditure. The next one is, fourth one is financial expenses. Interest paid. So firm has taken loan from creditor and firm is paying interest to them. Next, bank charges. We have account in one bank We are taking so many services from bankers. So in return, we are paying some charges to them. Then discount allowed. As debtor paid money to us before the due date, firm has given discount to him. That one. Discount on bills discounted. So bill means what? Bills of exchange, a written proof for credit transaction. And discounting a bills of exchange means what? So when we keep the bill with us till the due date, then from debtor we can take the money, bill amount. But before the due date only we want bill money. Then what we can do? We can sell that bill to bank on discount basis. That is called discounting the bill. Then bank people will not give the full bill amount to us. They will deduct some amount known as a discount and remaining amount only they pay to us. So that discount loss comes under financial expenditure. Next, interest on capital. So since the owner is separate and firm is separate according to business entity concept, when owner brings capital into the firm, we assume that we are taking loan from the owner. So if we take loan, we have to pay the interest now. That the interest charges come under financial expenses. Then fifth category is maintenance expenses. So the expenses which are related with maintenance of fixed assets. Sometimes we spend regular repair expenditure to manage that asset, and sometimes we renewal it for further period, and we provide depreciation on fixed asset. That depreciation charges come under maintenance expenses. The next heading is provision. Provisions means what? To meet future expenses. Sometimes what we do, from our present surplus amount, we maintain a provision. When we have to spend that expenditure, this provision money we use to meet that expenditure. Like that, we create provisions to meet bad debt loss, or to meet the loss of discount on debtors, to pay the tax, to maintain depreciation on fixed assets. Then last category is abnormal losses. Loss on sale of fixed asset, loss on sale of investments. We purchase shares, we purchase debentures, we purchase government bonds. Now we are selling them to others at loss. That loss. And loss of goods by fire accident or theft or any other reason. All these expenses come under indirect revenue expenses. Therefore, where we have to show them? On debit side of profit and loss account. Next transaction is revenue incomes. Revenue incomes means what? Any income is received by the firm in normal course of business activities. It is called revenue income. It is recurring in nature. Means again and again we receive this amount. Now these revenue incomes are again divided into two types: direct revenue income, indirect revenue income. Direct revenue income means what? It arises from the main course of business activity. For any business, what is the main course of business activity? Sales. Main income for any business is sale income. So we sold the goods and we received income. Now this income is called direct revenue income. It is to be credited to trading account. Okay. Then next one is indirect revenue income. Means what? If any income is arised from other course of business activities, then that income comes under indirect revenue income. It is regular income, but this income is not from sales, from other type of activities of business concern. We receive these incomes. For example, we have given loan to somebody. Now that a debtor paid interest to us. Otherwise, we have some favorable bank balance. On that, bank paid interest to us. This type of interest come under indirect revenue income. Next one, discount received. We are liable to one creditor. We paid the money before the due date. Then creditor gave some discount to us. This discount is called discount received. It is one indirect revenue income. Then commission received. We have given service to somebody. In return, we took commission from them. The next one is dividend received. We purchased other company shares and on that we received dividend. It is one indirect revenue income. Brokerage received. We acted as an agent of somebody and we did brokerage work there and we received some brokerage commission for that. Next, rent received. We lent some business place to one tenant and we received rent on that. This type of incomes are known as indirect revenue incomes. These incomes are to be credited to profit and loss account. Now the next transaction is deferred revenue expenditure. Means what? Heavy revenue expenditure is called deferred revenue expenditure. With one example, I will explain this point. We are running one firm and every year towards advertisement we are spending 60,000 rupees to 80,000 rupees. In 2015 year, we launched a new product and to promote that product, to create brand value to that particular product, we conducted heavy advertisement campaign. And in 2015 year, we spent 3 lakh rupees on promoting that particular product. Observe the difference between this regular advertisement expenditure and this heavy advertisement expenditure. In case of regular advertisement expenditure, the benefit from this expenditure is restricted to 1 year only. Therefore, in which year we spent that advertisement expenditure, in that year, in P&L account debit side, if you show that advertisement expenditure, that is enough. But in case of this heavy advertisement expenditure, even though we incurred that in 1 year, the benefit from this expenditure is for more than 1 year. We are expecting that because of this heavy advertisement campaign expenditure, we will get the benefit in 2015 year, 16 year and 17 year. So the expenditure is incurred in 1 year, but the income from that expenditure is for more than 1 year. In this case, we have to follow matching rule. What matching concept says? In one accounting period, income is to be matched with the expenditure. What is matching concept? If we show income in one particular year, then to earn this income, how much expenditure we spend, that expenditure also we have to show in that particular year only. And if you observe here, the expenditure 3 lakh rupee we spent in 2015 year, but the income from this expenditure is for 3 years. In that case, what we should do? Don't show total 3 lakh rupees expenditure in 2015 year P&L account. So make it 3 parts because the benefit from this expenditure is for 3 years. Then every year 1 lakh rupees we should debit to P&L account. So debiting 1 lakh rupee to P&L account is known as writing off the heavy advertisement expenditure. So how we have to account this? See, in 2015 year, when you prepare profit and loss account, advertisement expenditure incurred in 2015 year is 3 lakh rupee. But don't show that, you have to write only 1 lakh rupees. Then remaining expenditure 2 lakh rupee. That is to be shown as an asset in balance sheet. Advertisement expenditure 2 lakh rupees. You may get one doubt. How this is an asset to us? This is not an asset. There is no realizable value for this. So this type of assets are known as fictitious assets. Okay? And in 2016, when we prepare accounts, in profit and loss account, we have to show 1 lakh rupees as advertisement expenditure, and now from 2 lakh rupee, if 1 lakh is written off, then the remaining advertisement expenditure is 1 lakh rupees. Now that expenditure appears in the balance sheet. Now in 2017 year P&L account, last 1 lakh rupees will be debited. Now in balance sheet of 2017 year, we need not to show the advertisement expenditure because total expenditure 3 lakh rupee is written off now. 1 lakh rupee we cancel in every year by debiting to P&L account. This heavy advertisement expenditure 3 lakh is known as deferred revenue expenditure. In case of deferred revenue expenditure, how we are to show in final accounts? The amount which we are writing off in current year is to be debited to P&L account, and the amount which we are not cancelled appears as an asset in balance sheet. These are the examples for deferred revenue expenditure. Heavy advertisement expenditure, discount on issue of shares and debentures, underwriting commission, preliminary expenses, brokerage paid on sale of shares and debentures, research and development expenses. Now the last transaction is deferred revenue income. Means what? Heavy revenue income. With one example we will see. In 2015 year, firm received rent from one tenant. As tenant is going to abroad for 3 years, what he did is 3 years rent at a time he paid. Say rent amount is 6 lakh rupees. In 2015 year profit and loss account, we should not show 6 lakh rupees now. According to matching concept, this 6 lakh income is for 3 years. So 6 lakh rupee divided by 3. Then each year rent is 2 lakh only. Then 2 lakh rupee rent income you credit to P&L account of 2015 year, and the remaining income 4 lakh rupee is to be shown in balance sheet of 2015 year on liability side. Okay, like this in 2016 and 2017 also we have to do. So 2016 P&L account credit side rent income will be 2 lakh rupee, and in 2016 balance sheet liability side rent appears with 2 lakh rupees. And in 2017 P&L account, last 2 lakh rupee income you have to credit to P&L account, and in balance sheet of 2017 you need not to show anything.